Will Lucas for AfroTech here with my guy Marlon Nichols of MaC Venture Capital, formerly Cross Culture Ventures. This is not your first AfroTech. Tell me about your experience with AfroTech and what makes it so exciting.
We first invested in Blavity maybe 3 years ago now, so it's been since then. And every year it's doubled in size. I think this year it might have tripled in size. So it's amazing to see all these young black people, ambitious young black people running around.
You gave a really great talk last year about cap tables and helping people understand, their equity distribution and that whole thing. So a lot of tips, advice come out of the Bay Area in raising money. But if I'm raising money in, let's say, in Illinois or Tennessee, how do I apply that when my ecosystem may not be the same as raising money in the Silicon Valley?
It's all the same. It's all the same game. So there are going to be investors in wherever you are, right? And it's about you finding them. Particularly at the early stages, it's typically going to be angel investors. So people that know something about the industry that you're going into that want to support you, right? So target them first, get going, build something, and then once you have something and the traction is rolling, like, institutional investors are going to follow that traction, right? So as long as you build it, right, and it's doing what it's supposed to do, then you can start reaching out outside of your local ecosystem to bring in additional capital. But start local and find the people that make sense for your business.
You just talked about a little bit difference between angel investors and institutional investors. Can you dig into that a little bit? Because if I'm looking at an angel, maybe I don't have all the traction and data points there yet to justify going to an institutional like a VC.
So angel investors, they're investing their own personal capital, right? Whereas a institutional investor or a VC, someone like me, I'm investing out of a fund. So capital that I've raised from different groups of investors, individuals, family offices, foundations, endowments, et cetera, and I'm deploying that capital over a period of time, typically about 5 years, right? Angel investors, I said, their own pocketbook, right? What they need to see from you versus what I need to see from you is going to be different. Also, our check sizes are going to be different, right? They require less. They're also going to write smaller checks, right? I'm going to require a bit more, and I'm going to write a much larger check, somewhere $500,000 to 1.5, right? So I would say that's the key difference. And they're usually willing to get involved at the ideation stage, right? So you got an idea in the space. I know the space really well. I think I can help you. I'm a fan of what you're doing and of you and your team. All right, let me put some money in here and also some sweat equity.
Love that. And so if I'm thinking about raising money, how do I know how to price it? So am I just trying to get enough money to get myself off the ground, or am I trying to raise enough to build a war chest to not only get off the ground, but get far enough out to where I can keep competitors off? How do you think about that?
Companies can get in a lot of trouble, have gotten in a lot of trouble historically when they raise more money than they need. If you take on 5–10% more than what you actually need to hit your milestones, you're probably okay, right? But if you just pile on this capital and you don't have a use for it, it usually gets wasted, and it gets wasted in the form of resources. So now you're hiring a bunch of people that you don't need. You're probably pursuing a lot of different avenues that you shouldn't be pursuing right now, right? Because the name of the game is focus and just laser in on something, find success with that, conquer it, and then start to add, layers to it. If you have all that money, you're gonna skip the stage of making sure that the thing works and jump right into step 2 and step 3, and a lot of times failures happen as a result of that. So I always tell entrepreneurs, you wanna raise for an investment cycle, which is 18 to 24 months. Attached to that is a certain number of milestones that you wanna achieve, right? So how much do I need to raise in order to achieve these milestones within that time frame, right? And let's say I'm giving myself 24 months. Well, realistically, I should have hit those milestones by the 18-month point, giving me time to raise money when I'm not running out of capital.
And so this may be an interesting question to ask a VC, but being somebody who's seen a lot of cap tables and seen a lot of heartbreak, at the end of companies, talk to me about how you think about what entrepreneurs should be thinking about in the early stages of giving out equity to not only co-founders, but also to them early investors. What kind of things should they be thinking about?
Keep as much of your company early as you possibly can. So I always tell entrepreneurs, there are only 2 reasons that I think that you should be raising capital. right? One is that you absolutely have to hire the resources to build the product. There's no other way for you to build this product and get it to market other than raising venture capital to do that. The other is you're at a point where you've built something, and the only way that you're going to scale this thing, and let's say it's a competitive space or will be a competitive space, you got to scale and scale quick, right? So now you need the capital in order to do that. Scaling organically is just going to take too long. Those are, in my opinion, the only two reasons why a founder should be looking to take on venture funding. In terms of like employees, you want to be fair. There are reports in terms of like compensation reports that you can get from recruiting agencies and law firms and all that stuff. So I'd say get a hold of that and see what the average payout in terms of equity and salary, etc., for companies at your stage is, and just kind of stay as close to that as possible. You want to be competitive, but you also don't want to give away the farm.
Will Lucas here for AfroTech, Marlon Nichols, MaC Venture Capital, formerly Cross Culture Ventures.